Well, hello, distinguished guests, ladies and gentlemen, and welcome to the annual investment outlook from the CIO office at Emirates MBD. My name is Richard Dean. I'm a journalist and broadcaster here in Dubai, and it is my pleasure and honor to once again be hosting and anchoring this event. Look, we'll introduce our speakers very shortly, but I've got to say, when I think about this event as a business journalist as I am, I see it this year as in some ways the antidote to Reddit, the antidote to GameStop, the antidote to Wall Street bets. Honestly, if you're looking for speculative stock tips, you're probably going to be disappointed. This is not the place to come for wanton speculation. However, if you're looking for mature, evidence-based insights into investment in 2021 and beyond, then you're absolutely in the right place. Because our speakers today, and it's been my privilege to know them for many, many years now, they are some of the most experienced professionals in this region, in this industry, with, and I have to say this, a proven track record of success in equities, in fixed income, and in investments more broadly. Now, we're going to hear from them, and they're going to share their opinions, but I've got to say, they're not the only opinions that count at the moment. We'd love to hear your opinions as well, so we've got a couple of poll questions. Only 3. We're not going to bug you with these, but we'd love to get your thoughts. So, using the poll function on the platform that you're using today, can you do me a favor and answer this question? It's a multiple choice, dead easy, 3 options. The question is this: with regards to the virus and the economy, do you start 2021 with optimism, pessimism, or pragmatism? In terms of optimism, it's a kind of sentiment of we will defeat COVID and we'll come out even stronger before, the kind of build back better approach. In terms of B, pessimism, the virus is here to stay. The consequences are here for the long term. Or option C, pragmatism. The most important thing is to adapt to what happens. Whichever you think is your preferred option, please vote now, because our next speaker is going to be analysing those. And indeed, our next speaker is going to speak about how the COVID crisis and its response, the responses to the COVID crisis, have really shaped 2021. Going to talk about how this time last year, very candidly, he was perhaps a little bit dismissive of the impact of COVID-19, but also going to talk about the fact that notwithstanding everything that's happened in the world since we were last all together physically last year and hopefully again next year, things have been really, really good. The markets have performed incredibly well. So with that, let me introduce our first speaker today, our host today, in fact, the Chief Investment Officer of Emirates MBD, Monsieur Maurice Gravier. Maurice, over to you.
Thank you very much, Richard, and welcome to our Global Investment Outlook. Yes, this time it is virtual, but I'm sure that next year we'll meet all together. And anyway, whatever the format, it is an honor to have your time and your attention. So thank you very much. I will go through a quick recap of 2020 before telling you why we think that the age of magic money brings a constructive outlook for 2021, but raises questions for the longer term, which we have to adapt to. In both cases, our answers are more emerging markets and more selectivity. For the selectivity, my colleagues Anita and Satya will share their convictions in equity and fixed income before our chief economist Khatija gives us a full picture of the macro outlook for the region in a global context. So let's get started. And as always, I will start with what we said last year. Last year, we were expecting moderate but positive returns for our strategies, 4 to 6%. We highlighted flexibility to be ready to adapt to anything, and we already liked emerging markets. I must also say that last year, 1 year ago, at the very same event, I was not over concerned about this weird coronavirus coming out from Wuhan, China, and I thought it was going to be an issue for Asia and for Q1. Of course, I was so wrong, and here are the two shocks of 2020. The global pandemic, we know the story, and the global recession. Both were brutal and of historic magnitude. The good news, however, is that the responses were also massive and of historic magnitude. Let's start with the economic responses. It was an absolute emergency. Governments had no choice. They had to spend to support the economy, and they did. This is fiscal support. To do that, money had to be available in quantity and at a very low cost, so central banks put interest rates at 0 and massively increased their balance sheet, which means printing money. This is monetary support. This articulation of fiscal and monetary support is what we call magic money, and we'll come back to that. Second front for the responses, of course, healthcare. The vaccines came after they became available in less than a year, which is fantastic. So you have the vaccine making the crisis temporary, the policy response bridging the gap, so you have a new recovery ahead. So no surprise, markets, risk assets made a V, a crash in March, followed by a rally which was very sustained and accelerated in Q4 when US elections brought even more fiscal stimulus and, of course, the vaccines became available. So what happened to our strategy? I must say that the second message was the most important, flexibility. We changed our mind, and 1 week after our last year's global investment outlook, we made our largest risk reduction ever. We cut stock. You can see on the chart, it's the red triangle. We took profits because in February, before the virus has hit the shores of America, markets were up, so we sold. We reviewed our scenario. We recalculated our fair values. You know that we work on year-end fair values that we'll share with you. And then it became clear during the crash that we had to buy back, so that's what we did. We sold in February with profits. We bought back in March 30% lower, and we remained invested all the rest of the year. It was the key asset allocation move that we did. So 2020, as you can see on the left, it was a great year for investment, surprisingly at the end. Gold was our preferred defensive asset. It was the best performing one. Second best was emerging market stocks. We were overweight. So if I recap on our message, I was wrong on the COVID. Fortunately, flexibility was right. We adapted. Emerging markets was right. And my other message, which was that we were expecting returns of 4 to 6%, it was wrong as well. We did much better. As you can see on the right, our three profiles delivered in round numbers 11, 12, and almost 14%, which was not just better than when we initially expected, it was also much better than our average international competitors, which are there in orange, so we're quite happy with that. This was with 2020. Now, a new day, the sun rises over an ocean of liquidity. We call it the age of magic money, and let me take you through that. First, the amounts are massive. The chart on the left that you can see, it compares the total economic response by country to the COVID-19 crisis on the right with the great financial crisis on the left. It speaks for itself. There is absolutely no comparison. So the relevant question is, okay, we spent lots of money, but where does it come from? The answer is very simple. It was created out of thin air by central banks. They create it, they lend it by buying bonds, and governments spend it. This, the fact that we see monetary policy and fiscal policy working together has a name. It is a theory that existed for some time, which is called Modern Monetary Theory, MMT. We call it magic money time. And let me spend maybe a minute on that because it's something, of course, very important. The principle is simple. As long as a country can create its own money, it will never default on debt which is denominated in this very currency. You just have to print it to repay it. So for the MMT supporters, public deficits and public debt, it's not an issue. And it's not just not an issue. It is fantastic. It's great. It creates surpluses for the people. You create deficits, but you fund infrastructure, education, healthcare, or new ideas, universal income, helicopter money. So for them, it is a very good thing to have these deficits. And if you have an inflation problem at the end, you have full employment, you just raise taxes to limit the demand, and here it is. So that's for the theory. Now, did it happen in the past? Actually, there is one, I must say, very scary precedent. It happened 100 years ago in Germany. Germany had to repay the debt linked to the cost and the penalties of World War I. So they printed Deutschmark, a lot of Deutschmark. The result was hyperinflation, misery, default, and at the end, Hitler and World War II. It didn't end well. During the great financial crisis, central banks created lots of money. You remember quantitative easing, QE 1, 2, 3. But at this time, it was just monetary support to solve a financial crisis. Government deficit remained more or less in normal trends. Actually, there is only one example of this magic money being implemented at scale, and it is Japan. So let's look at if it's too good to be true, and let's take the Japanese example. In 2000, yeah, back in 2000, Japan debt to GDP ratio hit 100%. And maybe many people were saying, okay, Japan is gone, it's going to be bankrupt. 10 years later, it was 200%, and now it is heading toward 250%. Did we have a default from Japan? No. A debt crisis? No. If anything, as you can see on the chart, the blue line, interest rates went down. And the reason is that the central bank, the Bank of Japan, every month, you know, with the Japanese discipline, they create Japanese yen to buy as many bonds as the government has to sell. And at the end, you have interest rates are lower, no debt crisis, full employment, no inflation. It's magic. The rest of the world was very reluctant. Japan was unique, but you had no choice with the crisis. You had to spend because people had lost their job, their income, so you had to avoid absolute economic devastation, and central banks followed. So here we are. The US fiscal deficit this year, the budget deficit, should be close to 20% of the GDP. Even the very orthodox Germany, you see, for historical reasons, they go into fiscal stimulus. And the total response of Europe to the COVID crisis is, according to McKinsey, 30 times the current value of the Marshall Plan, you know, the Marshall Plan to rebuild Europe after World War II. So here we are, MMT, magic money time, it has arrived. Now the question, what does it mean for your investments? It means two things on two different horizons. On the medium term, for the year, it's a boost. We are not talking about quantitative easing from the great financial crisis who went just to financial markets and to the system. Government spent, it went to the people. And as you can see on the chart on the left, this is the disposable income from US households. It didn't go down during the crisis. It went up. Disposable income went up because of direct checks to households. So what have they done with this money? They spent part of it, you know, that's why the goods sectors are doing okay. That's why e-commerce is thriving, but they saved a lot. In orange, you have the savings rate. What does it mean for the future? It means that they have this money ready to be spent. And as soon as the virus is under control, they will spend in services, they will go out in restaurants, travel, and we have a new recovery ahead. So medium-term impact, it's a positive. Now, for the long run, it raises questions. Investments are about returns and risk. Let's start with returns. We have lower returns looking ahead. Why? Because interest rates have disappeared, they are super low, and equity valuations are high. So it means that returns looking forward will be lower. What about risk? Risk, you have the usual ones, you know, the business cycle, geopolitics, you name it, but you may have new ones coming from this modern monetary theory. Inflation, what about the value of currency? If you can print as much as you want, prices should go up. Zombie companies, they are companies that survive only because interest rates are very low, so they can service their debt. Otherwise, they couldn't. It means that as investment, they can be dangerous. They can be more dangerous than they look, especially if you have the speculation that Richard was mentioning, where you don't know what is a good company, what is a bad company. They also operate, they take market shares to others, so it's complicated. And finally, the crucial question, when will it end, this magic money? Can we end it? When, how, and what will happen then? We don't have all the answers to these questions, but we have to prepare for the long term. The first thing to do is to recalculate the expected returns that you may realistically get from asset classes in this new environment. That's what we have done. That's what is on the table on the left. I will not go into everything, but as you can see, the returns that we will get in the next decade are much lower everywhere than what we had in history. Forget the 5% you used to get from safe government bonds. It's over. It's going to be 1 to 2% at best. So what does it mean? You have to reallocate capital in a better way to take care of this new reality, and that's just what we have done. Our first answer to this modern monetary theory is a new strategic asset allocation. Our strategic asset allocation is the backbone of our investment process. It's your profile. What is a cautious, moderate, and aggressive investors? And for us, the definition is very simple. We want you to have a high probability of not losing money, capital preservation over 3, 5, and 7 years, and we'll give you the best possible return. What have we changed? Certainly not this promise, which is our signature. You won't lose money on 3, 5, 7 years. What we have changed, we have added much more emerging markets than before because the risk-reward of emerging market is totally better now than it was before. So that was for the long run, our strategic asset allocation, more emerging markets. It's high time, really, that the weight of emerging regions in the global economy is reflected better in portfolios. Now, for the year ahead, I also have 3 messages for you, and I know it looks like a copy and paste, and I swear it is not. First one, we expect positive returns because of the boost, and I'll come back to that in a second, but moderate returns. If I had to give a number, I think we will make more or less our expected returns, 3 to 5% on our profile. Second message, flexibility again, but more than ever because the consensus is now bullish, so it creates some risk and perils in the market. It is different from last year. Third message, again, you know it, emerging markets, all stars are aligned, not just for the long term, but also for the year ahead. So why positive returns? First, economic growth is here. The vaccine enables it, fiscal stimulus kickstarts it, and monetary stimulus turbocharges it. The IMF expects a global real GDP growth of 5.5% this year. It's the best number in like 2 decades. That's really significant. Second, after what happens, what is priced in? Valuation. That's an issue. US stocks have only been more expensive 4% of the time. We are 96% expensive compared to history. That's an issue. Third thing, sentiment. What moves the market? Another area of concern. Last year, you heard me saying every week and month and on every media that investors were too defensively positioned, so they would only buy at the end of the year. That's what happened. It has changed now. People are bullish. So before going into this risk and this volatility, let me have just a quick look at equity valuations. Are we in a bubble? You know, we hear lots of people saying, my God, it's crazy. Look, we are in 2000. And to some extent, it's true. Valuations are historically high, yes, on equities. They are not relative to interest rates. And it matters because asset classes compete within your portfolios and flows go to the most interesting. The chart on the left, I will spend 30 seconds, not more on it, I swear. It's interest rates. In blue, you have the short-term interest rates. You see the cycles from the Fed going to 0. In orange, you have the bond yields going close to 0 as well. The dark blue one is the equity earnings yield. It's basically when you buy 100 of equity, what is the percentage of underlying profits? So it's the inverse of the PE ratio, which, you know, we pay 25 times, more or less, so it means 4%. So look at this dark blue line. It's low, yeah. It's as low as it was in 2000. That's absolutely true, and to that extent, it is scary. But compared to others, back in 2000, you could get 6, 7% from a fixed deposit, from a safe US good old government bond. Now you have 0, so the difference is attractive. So we feel that, okay, historically expensive, but relative to yield, it's okay. And what gives us also comfort is that, yes, people are a bit too bullish. Lots of speculation in the short term. But if you look at the long-term positioning of international institutional investors in equities, they are just average. These guys, they need return. Think pension fund. They will not find them in bonds. They need to go in equity. So that's why we are quite okay with that. Still, elevated valuation and people bullish on the short term, it creates vulnerability and risks are everywhere. We have listed 5. By the way, you have much more details in our publication, which has been released 10 days ago. I will highlight the 2 first risks. First is the most terrible. COVID forever. What happens if vaccines don't work? It's, for us, low, very low probability, devastating impact. We don't think it's going to happen. By the way, personally, I have taken the vaccine. I've been lucky enough to have access, and I encourage everyone to do so. We believe it will work. We monitor the situation in the UAE and in Israel in terms of transmission because they are the leading countries. That's the key risk. If it happens, you have nowhere to hide except gold, probably. Second risk, of course, less policy support. If interest rates are rising, if central banks hike, we have an issue of valuation everywhere, and everything collapses, and there is nothing to hide, nowhere to hide again. We don't think it's going to happen for 2 reasons. First, inflation may rise temporarily, but the long-term drivers are still in place. You know, demographics, technology, globalization to keep it low, and the central banks are explicitly more tolerant towards inflation. Second, more pragmatic, No government can afford higher interest rates. We live in a world of huge debt. So now that fiscal policy and monetary policies are married, and the best example, Janet Yellen, she used to be arguably one of the most dovish central bankers ever when she was chairperson of the Fed. She is now head of the US Treasury with Mr. Biden. In Italy, who is asked to form a government? Mr. Mario Draghi, former president of the ECB. They work together. No government can afford higher interest rates. We are quite confident on this one as well. Emerging markets, I know I sound like a broken record. They grow faster. They have had a lower impact of the crisis last year, and they will rebound stronger this year. Think about it. In China, where it all started, China doesn't even have a recession in 2020. They are growing more than 2%. Second, they are cheaper, no doubt. You see the discount, very stable compared to developed markets. And third, they are less crowded. And again, it's time we reflect their weight in the economy. So our recommended positioning, this is the tactical asset allocation. We are overweight stocks, underweight bonds. My colleague will share their preferences within the asset class. We hold cash for flexibility, and gold is still our preferred defensive asset. We know that gold will suffer if interest rates and inflation expectations rise temporarily, but if anything, we are ready to adapt. And I think it's really the most important message. We are there to adapt. The team here, every month, every week, we will think and we will adapt. And for me, the ideal sequence would be to see a bit more euphoria in markets, to sell maybe developed market stocks 5% higher when we reach Anita's fair value, and to buy back gold on weakness. We're ready to adapt. This is how we do performance. And let me conclude on the performance. This is the 3-year track record of our asset allocation process, the one we have reshuffled 3 years ago. Our aim is to protect your capital better than others in difficult times. That's what we did in 2018. We are in blue. Competition is in orange. Our aim is to protect better in difficult times, to be as good as them when markets rally. In 2019, we were close to them, slightly below. We're very transparent. And this year, we've done both. We've been lucky with timing. Our calls were right. We're happy with that and your trust. And let me just tell you that this year, we have launched our very own multi-asset funds to reflect these strategies that we incubate and present for more than 3 years. So there is one cautious, one moderate, one aggressive fund implementing our TA to the dot with the best funds in the world selected by our talented products team. We are not the first one to do that. Really, it exists in every major international bank. But you know that today, the spaceship from the UAE will reach Mars ahead of the US and the Chinese one. So we take inspiration from that. We are not scared of UBS and JP Morgan. Thank you very much, and I'll see you for the Q&A.
Maurice, thank you very much indeed, not just for that insightful presentation, but also that entertaining presentation. I've got to say, one of my favorite social media posts of the past week or 10 days or so was you getting your vaccination with your T-shirt arm rolled up, so thank you for that. And on your point about MMT, magic money time, or monetary theory, modern monetary theory, one of my favorite book of last year was The Deficit Myth by Stephanie Kelton, who's kind of the high priestess of monetary theory. I know I should get out more, I should read more Jackie Collins, but it is a really, really good book about a really, really important subject. So, moving forward, over the next 30 minutes or so, we're going to do a deep dive for 10, 11 minutes on 3 subjects. First of all, equities, then bonds, and then we're going to speak to the chief economist about the macro outlook. Our next speaker is the head of equity strategy. Before I introduce her, we've got another poll question. So if you can go to the poll section of the platform that we're using today, can we bring up the question, please, so that people can answer this? Here it is. If you had to focus between only the UAE or technology in 2021, would you go for A, UAE stocks, B, technology, C, I'll take the 2? Now, on A, UAE stocks, the idea is that there are fantastic companies here in the Emirates at extremely compelling prices. And it's funny, as a business journalist, I was reading, it's earnings season. We had the numbers from the Dubai financial market itself came out a couple of days ago. And they mentioned in their earnings release that last year was the 20th anniversary of setting up the DFM, the Dubai financial market. I can remember as a junior reporter 20 years ago being really excited. Whoa, we're going to get a proper stock market down at the World Trade Center. And indeed we did. So that's UAE stocks. Option B is technology. Innovation is the only true source of growth. Or option C, I'll take the 2. Both are the future. Well, these are subjects that are going to be explored by our next speaker. as is, and Maurice mentioned this, and he and the ENBD team make no excuses about being a stuck record on the issue of emerging markets being a source of real value at the moment when it comes to investing. So with that, let me introduce our next speaker, the head of equity strategy at Emirates MBD, Anita Gupta.
Good afternoon, everybody, and thank you, Richard, for that vote of confidence. I'm going to talk about positioning in markets that are making new records every day. Looking at the poll question, for me, it's not between technology and the UAE. For me, the UAE is synchronous with technology. We have the UAE companies which are very much ahead on the innovation curve, whether it's DP World with the drones which they use for their container ports, whether it is Dubai port which has adopted blockchain as a payment technology. So to go into our positioning, over the last 5 years, we have seen US equities gain 100%, emerging markets not far behind, and technology double of that. When is the music going to stop? What are the industries of the future? Companies such as Moderna or BioNTech have now become household names like Clorox. When we look at our capital market model, the next decade, we expect returns of over 8.3% and from emerging markets and about 5.9% from developed markets. We are also seeing a rebound currently in both economic growth and corporate profitability, with, of course, virus-induced lockdowns with a start and stop, and a huge vaccine rollout globally. So how would we be positioning as we go forward? The chart in front of you, it's bumpy. It just illustrates that we do have drawdowns. However, if you stay the course, you make those 100% gains and use volatility as an opportunity. As Maurice said, we are overweight equities this year. Equities as an asset class has also historically given the best returns, and we also expect this to be true for this year at least. We look at 2020, we look at the exuberance. Global equities were up 17%, yet corporate earnings were down 15%. Regionally, China and emerging markets led, and within technology, we had a gain of 46%. So this leaves us with markets that are trading well above 10-year average valuations in terms of price to earnings. So what we have done is we have compiled a market health checklist. This looks at the positive and negative impact on earnings. Earnings, of course, remain the most important driver for performance because a company's value is just the sum of its future earnings. On the positive side, of course, we have seen a good Q4 coming out of the US with over 20% beat. We are seeing good numbers coming out of Europe. We are also seeing recovering consumer demand. And this, of course, has been accelerated by the shift to online. But surprisingly, even the luxury sector in Europe, companies like LVMH are posting strong Q4s. Geopolitical concerns have lessened, especially in our region. Of course, we also have a huge concern around technology regulation, wage growth, as the service sector, especially hotels and airlines, are still going to take time to come back to pre-pandemic demand. How do we position? We are overweight both developed and emerging markets with a slight bias towards emerging markets. Within developed markets, we are currently agnostic between Japan, Europe, and the US. But for the medium to long term, our strong overweight on the US remains. The US is not only home to the world's largest healthcare and technology companies, which continue to provide that performance which we have seen from US markets, 260% over the last decade. The technology and healthcare companies also have strong return on equity and growth, and which is why they are also our preference when we look at growth within sectors and themes. Within emerging markets, again, we are currently agnostic between EMEA and Asia and Latin America, but our long-term preference is once again Asia. This year and last year, we have seen a shift between growth and cyclical themes. However, what we would focus on is selectivity. If you look at that chart in front of you, you see that our portfolio, which focuses on companies which have sustainable growth and which have strong cash flows, It's up 90% over the last 4 years, and that's compared to 69% for global equities. So to come back to our sectors and themes, it's health and technology for growth. For cyclicals, we like financials. Rising yields are very good for net interest margins, also the lowest valuations. For income, there are a number of healthcare and consumer companies that have a dividend yield of over 3%. But to have the cherry on the cake, as we say, on top of everything, what we would focus on for the next decade is the synergy of health and technology, and of course, an overlay of ESG in everything we invest. We have calculated the fair values for the 8 major geographies that we covered. And we look at those index at the end of 2021. It's a very simple multiple, price to earnings multiplied by EPS growth. If you look at the price to earnings, it's a little higher than average. And the reason we can afford to estimate a higher price to earnings is, of course, as Maurice said, we are in a low interest rate environment, going to stay there. And also the very high earnings growth in 2021. For developed markets, for the US, we are looking at a 20% growth in earnings. For emerging markets, we are looking at a 30%. Now, this brings the US literally back to 2019 profits, and emerging markets just 10% above 2019 profits. So the returns that we expect from the US are around 8% into year end, already halfway there. From emerging markets, 14.4%. China, of course, leads again halfway there. And the GCC earnings and are going to be helped by oil. It's over there on your slide 50. But as we talk, we're already seeing Brent at $60. Very good for government spend. And of course, a resumption of economic activity. Just going to focus literally for 10 seconds on emerging markets. Of course, low valuations, high growth. China and India growth forecast at 8 to 10% GDP for 2021. Very young demographics, and of course the impact of digitization, which is providing access to goods and services to those very large populations. Significant is the growth of local brands, whether it is Reliance Retail in India, JD.com or Alibaba, who we all know in China, Mercado Libre in Central America. And also, above all this is the shift to local payment systems. Of course, everything is moving digital. You have Paytm in India along with 20 other local incumbents. You've got, Ali Pay in China. You've got Mercado Pago again in Central America. And this is taking away from the Western leaders like PayPal and other big, processors. So for emerging markets, we would say for the short term, we are agnostic, but longer term, we would look at Asia. Within our region, and of course, another emerging market, the UAE. Last year, we spoke about awaiting catalysts. Those catalysts are now in clear view. We have low valuations in the UAE. We have seen a very strong January. We have strong dividend yields. The Dubai market is at 0.9 times price to book. That's half that of emerging markets. And what's really encouraging is the opening up of the capital markets, stimulus from the government, relaxed visa regulation. That means more people coming in. And increased foreign ownership limits also implies that we'll have increased weight in the emerging market indices, higher trading volumes. On a sectoral front, we are overweight banking, telecom, and logistics. Banking, of course, higher yields. Telecom, again, good yields, as well as the increased use of data with work from home and streaming. And logistics, obviously, more deliveries, higher use of e-commerce. So now I'm going to shift to our themes. And again, if you look at, it's not a new trend that we're talking about. It's not a shift of consumer preferences. The blue bar is the performance of some of the themes that we have liked for the last 3 to 4 years. And if you look at it, airlines and hotels have not performed for quite some time. This is not just a pandemic-induced, drop in the performance of those sectors. And again, if you look at genomics and FANGs, it's not just that last year they made over 100%. They have been performing over the last few years. all that the pandemic has done, and we still think there's plenty of performance to be made from there in our three themes. That's around connectivity in the technology sector, preventative healthcare, the synergy between health and technology, and of course, overlaying all this environmental, social, and governance factors. So to come to our first theme, the technology sector, of course, we've spoken about this many times, but today technology is not just about the internet, it's not just about your software and hardware, it is the connectivity of services between your home place, your workplace, the marketplace, it is your health, wealth, and mind metrics. But that brings us to concerns around privacy and data. Are we willing to share all our data with these large tech companies? It also brings us to social media, and you can see in those circles the number of daily active users. And are social media companies today becoming the new content police? We all saw that Google, Alphabet, and Amazon stopped a new social media site, Parler. They took it off their platforms because they felt that their content was not suitable. Are we in bubble territory with technology? This is on everybody's minds. You have traditional car companies today that are moving to becoming technology companies, whether it's Volkswagen in Europe. You had Tesla is not considered an automaker. It's a tech company. You have new trading platforms that are influencing markets. So what are the trends that we see for the next decade? What is going to continue to make higher returns in the technology space? You are seeing, of course, global customer digital interactions increasing. And that, of course, brings us to the need for better digital payments and cybersecurity around it. E-commerce is not just about the growth of $4 trillion market, it's about the logistics, the speed, the quality, the flexibility, and connectivity, which is 5G. And it's not only the speed, again, in 5G or the download or the infrastructure, it is also enhancing cloud services. Data, of course, today is even more important as, with the pandemic, mobility trends, consumer trends, much easier to measure. The two themes that we have talked about for some years, of course, have been health tech, which we're going to talk about a little more, and electric vehicles. Now, there are estimates that about 25% of the fleet on roads is going to be electric by 2030. And if you add the Apple car, which is a possibility, it's probably going to be even higher. But electric vehicles is not about the production, it's not about the astronomical rise in prices you've seen in a Neo or a Nikola or a Tesla, it's about the batteries. It's about the life of the battery, it's about the cost of that battery. When Tesla had its first two-wheel roadster in 2008, they actually used 7,000 batteries which were being used in laptops. Today, of course, you have the battery as just one unit. But to come to a theme for the next decade, and that, again, as I emphasized, is the synergy between health and technology, the need for preventative healthcare as governments spend more and more money. Today, you have a younger, technology-savvy customer, an aging population, all focused on healthcare. Besides, of course, the returns you've seen from some of these, healthcare sectors, what we are looking at is the change that artificial intelligence has brought, the use of data has brought into healthcare, the possibility of the rollout of a vaccine much faster in a year compared to what was, 10 to 15 years earlier. Telehealth, which allows 2.4 million people in Rwanda, thanks to Babylon's subsidiary, which get access to healthcare. And of course, your wearable. Don't forget that. Today, the new Apple Watch can even measure your oxygen levels. But overlaying all this is the environment. And of course, you can see that beautiful environment behind me. And we all want to preserve and maintain that. It's about clean water. It's about renewable energy. The IEA estimates that renewable energy will overtake coal as the largest source of power. We are also worried about climate change. A number of countries have promised to be net emission free by 2050. Also, sustainable investments are very good returns, and we have seen a doubling of money into sustainable investments in 2020, and that's going to continue. So to conclude, for making the best returns, stay invested, weather the volatility, and for growth, stay with healthcare, technology, and emerging markets. Thank you, and back to you, Richard.
So thanks very much indeed, Anita, for that insightful strategy. Before I introduce my next guest, let me admit to being in a slightly nervous situation here. I'm conscious that I'm English and my previous speaker was Indian and my next speaker is Indian. And since we've been broadcasting, England has beaten India in the first test match in Chennai in India. So I'm kind of in the lion's den at the moment. It's one of the few times that I'm glad that we're observing 2 meter social distancing here. It helps me stay safe. But we move on now to our second deep dive by asset class, and we turn our attention to fixed income. And we have a question for you on this. So if you can go to the polling part of the platform we're using today, that would be great. The question is this: the 10-year US government bond yield is currently just 1%. 1%. For you, is it A, ridiculously low, given the levels of debt? B, reasonable? It is safe, and at least it's not negative. I guess that's something. C, attractive. Central banks will keep on buying it and keep on buying it to go. So which of those options most accurately reflects your approach to the fixed income market at the moment? Now, our next speaker, it's a real pleasure to introduce him because 3 of the 4 speakers that you're going to hear from today are veterans of this event. It is not their first rodeo at the Investment Outlook for the CIO office here at Emirates MBD. Maurice Gravier, Anita there, and a little bit later on, we'll hear from Khatija Hack from the economics department. But our next speaker is making his debut at this event, and it's a real pleasure to have him here today. He's going to tell you why he believes that we should favor the most aggressive segments of the fixed income market at the moment. Going to talk about last year that the bank was favoring emerging markets in bonds, GCC in particular, and both worked out fantastically well. Ladies and gentlemen, please welcome our next speaker to do a deep dive on the bond market, the head of fixed income strategy at Emirates MBD, Satya.
Thank you, Richard. Good afternoon, everyone. Welcome to the fixed income part of the session. Here we'll focus on our positioning, strategy, and try to answer the million-dollar question if there will be a temper tantrum. But the starting point first. As you see on your screens, there has been a massive and vast spread compression after March 2020, driven by monetary policy support. What that means for sub-asset classes basically is that all of them are trading below their historical medians and very close to their January 2018 historically low levels. So low rates plus low spreads means low return for fixed income investors. And our challenge throughout this presentation is to present you opportunities, strategies, and pockets of opportunity where you can actually earn decent returns. Where do we go from here? Our advice to clients is get comfortable with risk. First of all, very interesting answers to the poll questions. Here we reveal our view. We think the 10-year treasury yield will end the year at around 1.2%, but obviously there is an upside risk to it. But apart from that, the safe haven assets like the developed market government bonds and global IG credit will give you very low to negative returns. On the contrary, the riskier asset classes like high yield and emerging market debt should give you capital appreciation and opportunity to clip the coupon. What about our regional assets? They've actually surprised investors in the last couple of years. In 2019, they actually topped the returns chart, and in 2020, they finished second. But that means all the low-hanging fruits from the region have been taken out. Are there any pockets of opportunity? Of course. That's what we are going to show you when we do a deep dive. Starting our deep dive from developed market bonds. Our view is that they no longer mitigate the risks well enough. Why is that? Just look at the chart on your screen and see how the US Treasury yield curve has shifted down in 2020. Combine that with Fed's unwillingness to actually go into negative interest rate regime, and what you see is that there is hardly any headroom left for actually yields to move down, and government wants to give you some kind of capital protection during times of stress. On the contrary, actually, we think the yields might actually go up. There will be a bear steepening of this curve, so 10-year and 30-year treasury yields should go up in the future quarters. What that means for the long duration bonds you hold is that they might actually give a capital loss. And that's why we advise our clients not to take any fresh positions in ultra long duration bonds and to keep the duration exposure shorter, probably than 10 years. What about investment grade credit? As you can see, that there's been a massive spread compression between June 2020 and January 2021. Especially look at the triple B category, which used to drive the majority of the returns from the asset class. It is now trading at around 1.2 to 1.3% kind of range. And what that means is that even if there is a slight increase in the 10-year and 30-year treasury yields, years of returns from this asset class will be wiped off. And that's why we are underweight this asset class. So high yield is basically the best asset class, in our opinion, to give you good capital appreciation. Technically, the high yield indices are trading at 380 to 400 bips. What that means is that the lowest ever spreads they have reached was in January 2018 at around 310. So they have quite a headroom of 80 to 90 bips of spread compression left in them. And that's where you get capital appreciation from. Fundamentally, if you see, the default rates have stabilized after peaking in Q2 2020. We take great pride in actually telling you this, that we cover 500 bonds under our advisory list. And there has not been a single default from our list last year, despite the 12-month trailing default rate actually doubling to 5.5% last year. So fundamentally, also, there is another factor that supports the default rate. Low default rates is basically that high yield issuance has actually created a record in 2020. And this year, the high yield issuers are expected to sell more than $400 billion of bonds. What that means is that most of the B and BB rated issuers have lots of cash to tide over any uncertainties. And that means we have fundamental and technical factors come into play and support this asset class to give you capital appreciation. Emerging market debt, here selectivity remains the key. Why is that? If you look at the chart on your left side of the screen, we are right there at the top. The current spreads are below 300. That means the 12-month forward returns should be somewhere between 3.3% to 3.5%. But remember, emerging market debt is not a homogeneous asset class. It has ratings and regional dispersions. So what do we like? Asian high yield. Why? Because they provide you the highest duration adjusted returns. What does that mean? Look at the chart. On the x-axis, we have plotted duration. Basically, higher the duration, higher the interest rate risk sensitivity. And on the left side, on the y-axis, we plot returns. You can see that Asian high yield actually stands out in terms of a ratio between the return to duration. And that's why, technically, it actually gives you the best risk-adjusted returns. But fundamentally, remember, almost 60% of this asset class comprises Chinese real estate high yield issuers. And the regulator there has been very hawkish in the way that they have come out with a new 3 red line rule. If the issuers do not qualify that, they cannot grow that debt. That means there will be very less amount of debt issued this year as compared to the previous years. So whatever amount of debt is there, the yield changes will basically lead to capital appreciation of those bonds. But what's more important is that any debt that is being issued this year are going to be from very strong issuers, and we might see re-ratings. But how do you play this Asian high yield? The best way to play this is through funds. That way, you get a diversification and you do not get exposure to the individual company credit risks. What about our regional markets? As I told you, the low-hanging fruits of the region have been taken out. We present you 3 strategies how to play this market. If you are constrained by your mandate to invest in IG credit, then focus on the sovereign-owned entities like ICD, like DP World, like Seiko, SABIC. All of them trade somewhere around 15 to 20 bips wider to the sovereign curves. So there you get a pick of a yield. And again, the low cost of leverage and the low volatility we expect in fixed income this year could allow you to lever them and get that uptick in the yield. Coming to high yield, we like Oman and Egypt over Bahrain because of the juicier yields that they give. But positioning remains key here. We prefer the 7 to 12-year part of the curve. Why is that? You go to the left of the 7 years, and then the yields are low and uninteresting. If you go to the right of 12 years, then the curves, as you see on your left side, is basically very, very flat. That means you're not getting that yield pickup even if you are taking additional duration risks. Now, the last opportunity that we have identified is subordinated bank debt. Why is that? Just have a look at the chart on your right side of the screen. The ratio between subordinated and senior spreads have been presented and benchmarked against iTraxx index. And you can clearly see that the GCC banks give a better relative value in subordinated debt, and that's where you can capture them. And we understand that the champion banks from the region are well capitalized and are in no danger. Now that we have covered conventional asset class, let's talk about sukuks. It's a very challenging backdrop for sukuks, mainly because of the yield distribution. You can see that 80% of the sukuks actually yield less than 3%. And add to that, more than 50% of them mature within 2022 and 2025. What that means is that if you chase yield in sukuk and go for 6%, 7% yielding sukuks now, they would have been issued by very high-risk corporates. And they might find it very difficult to refinance when rates and yields finally rise in 2024, 2025. They will face a lot of difficulties at that time. So how do you play this? Basically, copy our MENA playbook to sukuk, and you should be good. Now, as I promised, answer to the million-dollar question. In fact, we are answering two questions here. First, will there be a taper tantrum this year? Second, if there is a taper tantrum, yields rise, how do you protect your investment? So, answer to the first question is a politically correct. It depends. Why? Because in Q2 and Q3, we think a combination of high fiscal stimulus, monetary policy support, and base effect will lead to inflation expectations rising. And at that time, Fed communications remains key. Fed has to hammer three key points, in our opinion. First, they have to set aside any discussions about tapering of asset purchases as premature. Second, they have to mention that they will look through any transient uptick in inflation. And lastly, but most important, they have to emphasize that they will not increase rates till we achieve full and inclusive US employment, right? But despite Fed's efforts, markets can become irrational. Markets can become nervous, and at that time, yields can rise. So the next question, how do you protect your portfolios? Again, we come to you with three strategies. First, it's a cliche, but diversification is your friend, especially emerging market equities and cyclical sectors, which have performed really well during times of strong economic growth. They should protect your portfolio. Second, our preferred asset class, high yield and emerging market debt, as I have been telling you, have enough spread headroom to protect against rising yields. What does that mean? Between November 2020 and Jan 2021, the 10-year treasury yield increased by 30 bips, but high yield and emerging market spreads compressed by almost 70 bips, providing a positive total return. And that history can repeat itself because that spread headroom still is there. The third is for qualified investors. You can take positioning in special structured products which protect the downside and which can actually give an upside when 10-year and 30-year treasury yields rise. So that's how you play the rising yield and you play the taper tantrum. Thank you, everyone. That's all from my side. See you in the Q&A session. Over to you, Richard.
Thanks very much indeed, Satya. Fascinating insights. And talking about what the Fed will do, it's fascinating that we've got a former Fed chair as the Treasury Secretary as well, and also, of course, Jay Powell in the Fed himself. So we'll see what happens there, and we'll watch that one with keen interest. Interesting also that your hedge is the emerging market equity strategy, which we know Anita spoke about a little bit later on. Look, these guys are going to be back on stage in about 10 minutes' time to answer your questions. We've already got loads coming in, but if you've got a question, use the Q&A facility on this platform, and we will put them to these guys in about 10 minutes' time. But we move on now to our final presentation today, looking at the macroeconomic scene. Now, I'll introduce our speaker in a couple of moments. First of all, though, we have our third and final question for today, or fourth and final question for today. And the question is this: in your opinion, will the economic consequences of the crisis on our region be one of the following? It's multiple choice. A, temporary, B, sustainable, or C, differentiated. And here are the options. Temporary, we are well placed to fully benefit from the rebound. That's the more optimistic view of what's going to happen going forward in this region. Remember, it's about this region. The second one, sustainable, well, that's more balanced, saying it's going to take a long time to get back to pre-COVID activity. And the third, and this is perhaps the more subtle and nuanced answer, is differentiated. Different impact on different sectors. We will adapt as always. I know the radio station that I broadcast from, the guys upstairs from us on the floor above are Amazon. They've had a pretty good time of it over the past 12 months or so. Other sectors in Media City, where I'm based, have really struggled. So differentiated, I can see a lot of merit in that argument. Look, our next speaker needs little introduction to people who've been at these events before. But on a personal note from me, it's a real pleasure to congratulate our next speaker, Khatija Haque, on her promotion to be the chief economist and Head of Research at Emirates MBD. I've known her for many, many years as the Head of MENA Research at the bank, and she knows this region very, very well. But this summer, she succeeded Tim Fox to the Chief Economist role. So it's my great pleasure to welcome the Head of Research and Chief Economist at Emirates MBD, Khatija Haque. Khatija, over.
Thank you very much, Richard. And just the results of the polls have come in. Around 60% of you think that the impact of the pandemic on the region is option C, so different impacts on different sectors, and we will adapt. And I would probably agree with that. And we'll talk through how some of the sectors in the UAE in particular have evolved through the pandemic and what the outlook is. But before we look at the UAE and the region in more detail, I want to just touch on what the global backdrop is, because clearly the UAE in particular is a very open economy. What happens in the rest of the world matters. Now, I'm not going to spend a lot of time because Maurice has talked quite a lot about the improving growth outlook globally, the IMF expecting around 5.5% growth this year. He's talked about supportive fiscal policy and, of course, magic money, or in the way I would say it is really supportive and easy monetary policy for an extended period of time. But what he perhaps hasn't drawn out in detail is that the consequence, or one of the consequences of easy monetary policy, is a weak dollar. And given that the UAE and other GCC countries have currencies which are pegged to the dollar, that is quite important for our region. Now, over the last couple of years, or at least before 2020, we went through a period of dollar appreciation. And what that does is it erodes competitiveness for dollar-based economies like ours. Particularly that's clear in the services sector, where the dollar has gotten stronger. It's become more expensive for people to come on holiday in Dubai and to buy goods and services here. And that has driven to some extent the deflation that we've seen in the region over the last few years. Now, going forward, a weaker dollar is actually quite helpful for an overall economic recovery in the region because it helps to restore some of that competitiveness that has been lost in previous years. But it's also quite positive for commodity prices, and in particular oil prices. So generally, when you have a weak dollar story, you tend to see firmer commodity prices and higher oil prices, and that, as you all know, is very important for our region still. So if we look at what we're expecting for oil this year, we've had a very strong start to 2021. We've already seen Brent prices top $60 a barrel in the last couple of days. But the broader story is a little bit more nuanced. And of course, there are risks on the downside as well, which we don't want to underplay. So really, the rally over the last couple of weeks has been on the back of vaccine rollouts and more optimism about global growth. But the fact remains that most of the developed markets have remained in some sort of lockdown to varying degrees for most of January, and that is only going to be gradually eased over the coming weeks. And so the demand for oil, at least in the first quarter of the year, may actually be weaker than what the market is expecting. We also have some concerns about the supply of oil. Now, OPEC has been quite aggressive in terms of containing production to balance the market. But as prices rise, you will start to see non-OPEC producers coming back into the market and producing more to take advantage of high oil prices. So that becomes something of an issue for upside in terms of prices. So on average this year, we're sticking with our view that Brent oil will average around $50 a barrel. There will be periods when it's higher than that, but equally there will be periods where it's probably a bit lower than that as well. And that's the environment that we're going into in terms of looking at what governments in the region can do to support growth this year. And I think it's important to recognize that one of the reasons why we didn't see as much fiscal stimulus, direct fiscal stimulus in the region last year as we did in, say, the US or Japan or parts of Europe is because of the impact of low oil prices and low oil production on budgets in the region. So what we had was governments focusing instead on making sure that there was enough liquidity in the financial system, using central banks to provide liquidity to commercial banks, which could then offer support to clients who needed debt restructuring or extra credits and extensions on loan payments. So that was the main mechanism for mitigating the impact of the pandemic on the environment or on these economies. And we didn't see the same kind of direct support for households and businesses that we've seen in some developed markets. So as a result, growth this year is probably going to depend on what happens in the rest of the world. It's going to really be driven by an improvement in the external environment. As global demand picks up, we will see a pickup in international trade. Hopefully, as restrictions are lifted, we will see travel and tourism come back as well, and a natural recovery as activity normalizes. And so when we look at our forecast for growth, it's a lot more modest than some of the bounce backs that we would expect to see in other economies where there's been more direct fiscal support. We've got a forecast of around 3.5% for non-oil sector growth in the UAE this year. That's following on from an estimated contraction of around 6.7% in 2020. However, the headline growth figure is going to be a little bit lower at just under 2%. And that's partly because the oil sector is only going to recover very slowly in the second half of the year. So we don't expect growth in oil production to contribute positively to GDP this year. It will probably still be something of a drag. In terms of what we've seen over the last several months in the data, the PMI surveys have indicated a stabilization and some modest growth in the non-oil sectors over the last few months, but we haven't seen that reflected in job growth. And that's quite key to an economy like the UAE, where the vast majority of the population is expatriate and dependent on jobs in the private sector. And so where you don't have stability in the job market and growth in jobs, it's very difficult then for that to feed through to stronger consumption, which is really what we're looking for to drive a recovery in the absence of government spending. I would also highlight that businesses in the UAE are relatively cautious about the outlook still. I think there is some concern about how long the restrictions globally will remain in place, to what extent restrictions might be imposed in the UAE as well, and how long it's going to take for this pandemic to really work its way through before businesses feel comfortable with boosting their investment, boosting their hiring. And one indicator of that has been really the lack of appetite for credit in terms of private sector credit. So if we look at private sector credit growth in the UAE in the second half of last year, that actually declined on an annual basis. So that's just highlighting really, the lack of appetite on the part of businesses and even consumers to some extent to go out and borrow money and spend it or invest it. Looking at some of the key sectors quickly, I mean, the obvious ones to be impacted by the pandemic were obviously hotels and restaurants, transport and storage, and wholesale and retail trade. And we saw in the second quarter of last year quite significant contractions in those sectors because of border closures and restrictions on activity. We have seen, manufacturing hold up quite well, and we've seen financial services hold up quite well as well. And construction didn't contract as much as we might have expected. And hopefully those sectors will prove a strong anchor for a recovery that's coming through in the latter half of 2021. If we look a little bit at the hospitality sector, we can already see at the end of last year a strong bounce. As soon as there was restrictions were lifted and people were able to travel and felt comfortable traveling, we saw pent-up demand showing up for tourism in Dubai. Hotel occupancy picked up to over 70%, and hotels were able to charge more per room period than they have through the course of the year. So a really strong finish to what was otherwise a pretty disappointing 2020 from a hospitality point of view. But I think the silver lining is, yes, we don't expect that to be sustained in the first part of this year. We've seen restrictions on travel being reimposed in other parts of the world, and obviously that's going to have an impact on the number of people coming to the UAE. But I think what's important to recognize is there is pent-up demand. So as soon as we start to see a greater coverage in terms of vaccination, lifting of restrictions, we are expecting that to feed through in terms of improved numbers for tourism in the UAE. And then finally, on real estate, which is always an important sector to look at, we have seen some signs of, I wouldn't say recovery, but at least a bottoming in certain segments of the real estate market in Dubai, which has been a little bit surprising considering the impact of the pandemic. But what we've seen is a preference for larger properties, for villas rather than apartments. And so prices for those more in-demand properties have stabilized and actually picked up a little bit in the fourth quarter of last year. Going forward, we are still a little bit concerned about the pipeline of new supply coming into the market. That is probably going to weigh on any recovery. But on the flip side of it, you've got record low interest rates and also an overall drop in prices in residential real estate relative to, say, 3 or 4 years ago. So from an affordability perspective, real estate is more affordable now than it probably has been at any time in the last 4 years. In terms of what's happening in Saudi Arabia, it is the biggest economy in the region. What happens in Saudi does impact the UAE. We have seen quite a strong rebound in activity in the non-oil sector in the kingdom over the last quarter of 2020. You can see that in the PMI surveys. But what that hasn't translated to, again, is a pickup in private sector employment. Now, to a lesser extent, that's not as important for Saudi Arabia as it is for the UAE, because the vast majority of population in Saudi Arabia is in fact Saudi, and they tend to work primarily in the public sector. But what we have seen at least is improving sentiment on the part of businesses in the kingdom. They are more optimistic about the outlook for 2021. Yes, the government will reduce spending, but that is going to be offset by increased domestic investment from the Public Investment Fund in the local economy, which should help to offset that impact of less government spending and overall support demand in the economy this year. I think I'm going to stop there and hand back to Richard.
Khadija, thank you very much indeed for those insights. Really appreciate it. Certainly your points on the property market are well made. My family and I tried to buy a family villa in Dubai in December and January. The market was on fire. The prices on a Monday were much higher by the time you got to a Thursday. So we'll look at that one very closely going forward. Right, let's jump into the Q&A round now. We've got the three of our speakers here today. We've got Maurice, Chief Investment Officer for bigger picture stuff. And for more narrow focus, we've got Anita looking at equities. We've got Satya looking at the bond market. Maurice, I'm going to throw this one at you first of all. Maurice, what's your view on Bitcoin up more than 10% overnight? Is it now a legitimate, credible asset class?
Wow, fantastic question. And let me be very honest, when we are not experts in a topic, we don't formulate recommendations, and we have to work more on Bitcoin. What is certain is that you create so much fiat currency that you debase them, and there are really reasons to believe that you need an alternative currency that cannot be controlled by a central bank when you reach a point where you don't trust the central bank anymore. For the time being, we believe that gold could play this role of store of value, because if Bitcoin is worth 46,000 or something, maybe gold is cheap, because gold is a universal store of value and a currency you cannot print. Having said that, we have to work more. We have started working on cryptocurrencies. It's difficult to value, and you've understood that our fundamental framework is about putting a valuation. You have no cash flow to integrate. So yes, we haven't recommended on it because we are not expert on it. We are working on it. Alternate stores of value make sense, and gold plays this role currently in our portfolio.
Anita, a question for you specifically on equities. Someone writes in, given the record valuations on Wall Street, another record overnight, I'm concerned about a correction, if not a full-blown reversal. What's your view?
Volatility is part of market returns, and every year, historically, you see at least 1 or 2 5% drawdowns and 1 10% drawdown, and that's in normal markets. So I really wouldn't worry about, is there going to be a fall from the high level of the index? We only look at the fundamentals. We look at where valuations are. Are those valuations supported by growth? So at least for the time being, for 2021, we are seeing very strong economic growth, very strong corporate profitability growth. We are seeing a lot of stimulus coming in from the market, especially the US. So as long as you have consumer demand picking up, companies spending, companies actually doubling the technology budgets, I don't see this leading into a full-blown recession at this point.
Satya, a question for you about fixed income. The question is this. You mentioned Asian high yield is predominantly China. I'm worried that might be predominantly Chinese debt, and there are concerns over that. What can you say to that?
So as we mentioned, that Asian high yield actually comprises a large part of Chinese real estate high yield issuers. And there the regulator has been very, very hawkish. This year, as I mentioned, there has been 3 red lines. Prior to that, they had actually told that any debt, primary debt that is being issued, it cannot be used to actually develop primary land purposes. What that means is that they are trying to stem any kind of bubble from building up in that sector. And when we mention Asian high yield, you get actually paid for the risk that you are taking. And you cannot avoid China when you are in emerging market, especially if it is emerging market Asia that you are focused on. And that's why we have a very high comfort on Asian high yield as our preferred asset class.
Satya, thanks very much indeed. Maurice, a question for you, and it's a question about fees. The question is this: given that you're expecting returns to be lower going forward, does that mean we can look forward to lower fees from our investment managers?
Oh my God, what a good question. And if anyone thought that we were preparing the question, I think you have the answer. Well, it's right. When you had expected returns of 7%, your advisor could take 2%, and you were still left with 5%, which was great. And with expected return at 4%, it's different. So the short answer is yes. We have to have your money working for you before and then take a fair share. But the other part of the equation is that we believe that active management has a value and more value looking forward, because the big move of the last 10 years, you could get them with ETFs, and it was a very nice way to do. And ETFs are still compelling in some cases, but looking forward, if your asset allocation is right, which means some work, I mean, if you outperform the average competitor by 2-3%, I think that it has some value. Same if you select the right securities with my colleagues or the right funds. So it's about a fair share. And by the way, I'm just thinking, I mentioned our new asset allocation funds, which are called the signature funds, which implement the very strategy that we presented to you today. We have paid extraordinary attention to make them very highly competitively priced compared to our competitors to the universe. We invest in the underlying funds in the cheapest possible share classes we find, and on top, we take a very modest fee. So, fair question.
Thank you, Maurice. The curveballs are coming in. I'm not writing these questions. I'm just asking them. This is one for you, Anita. You say you're positive on UAE equities. Is that because you're biased, because you work for a big UAE bank?
To be very honest, we haven't been positive UAE equities last year till about October. So if that bias was there, it would have been there right through. In fact, last year we spoke about awaiting catalysts, and we saw those catalysts sometime around October. I think all of us living here in the UAE realize the tremendous measures the government took in terms of getting economic growth back on track and getting industry functioning again. We are ourselves, seeing the apps, the ease of paying your Diva bills, the ease of, working in this country, which is what, are the ground points that we see which make me positive the UAE. And of course, we saw tourism pick up. That will go in starts and stops. No, I'm not positive the UAE. Again, it's back to fundamentals. It's not because I work for a UAE bank. It's purely because it's low valuations. We are seeing growth. And of course, we are seeing good dividend yield.
Satya, a question for you about the bond market. You say you are underweight the safest bonds and overweight more aggressive stances. Last year, you had no defaults. You dodged a bullet last year. Why are you confident that you will do the same this year?
Firstly, because our security selection that we do is very robust. We have partnered with the best research providers, and we do a deep dive. I myself have a background in credit analysis, and we try to use that to full in my team when we try to onboard any new security. And we take pride in basically selecting the best bonds, looking at the best credit metrics, and that's why we think even this year, we will be able to dodge any kind of bullets. But remember, the background is much better, much benign this year than previous year. Last year, for almost a couple of quarters, the funding markets were closed to the riskiest of investors. But everyone can refinance now. Even CCC rated entities are coming to the market to refinance. And when that happens, you can be sure that a lot of companies will refinance their nearest obligations and they will themselves tide over any short-term uncertainties. And that's why we think that there will be very low defaults this year.
Thanks very much indeed, Satya. Okay, next question. This one's actually for Khatija, but I'm going to throw this one into your in tray, Maurice, if I can. It combines economics and politics, so 2 for the price of 1. Do you think that the new Biden administration will be better for our region in terms of economic impact or worse?
Oh, I guess it's for me, not for Khatija.
So Khatija's not here, so I'm afraid that we may
not have the line. Well, I want to take something from Khatija was absolutely right to mention that with the current setup in the economic policy of Mr. Biden, it means a weaker US dollar, and that's something that is overall, I must say, very supportive for our region and for the emerging market world in general. I wouldn't say that what Mr. Trump, his action towards the region were that negative. And what I like also in Mr. Biden's program is this angle towards renewable energy and this kind of thing, which could at the end limit maybe a bit the supply of oil from the US. We will have to see more. What's for sure is that the current policy is good for the global economy and tends to weaken the US dollar, which is absolutely great for emerging markets in general and our region in particular.
Thanks very much indeed. We've got time for 2 or 3 more questions now, very quickly. Anita, this one's for you. You say that you're long on technology, but within that asset allocation in equities, which are you more focused on? Subsectors of technology, e-commerce, cloud computing, electric vehicles, batteries, and so on?
Actually, it's more a broad overview on technology, and everything is interconnected. Today, we are in a stage of e-globalization. So it's e-commerce. E-commerce, of course, remains a major subsector within technology. It is 5G. It is electric vehicles. So when we look at, it's like a core and a tactical. So if you look at the core will always be your e-commerce, your data, your artificial intelligence. And tactically, on top of that, you will have your 5G and your electric vehicles.
Another question for you, Anita, about the regional markets. Given that you are long on emerging markets and this region, specifically which sectors in the UAE and Saudi Arabia do you like at the moment?
At the moment, absolute number 1 would be banking and financials. We have low valuations, you have improving net interest margins, you have the banks in the UAE especially paying out dividends, and of course income is very important for all our investors. That would be the number 1, of course, followed by telecom, use of data, and number 3 is logistics.
Maurice, a question for you, picking up on the magic money time. Lots of people have written in about this. Someone says, what are the concerns about inflation? And just to add to that, it was interesting, Larry Summers over the weekend, former US Treasury Secretary, a Democrat, so supportive of the Biden-Yellen administration, being quite critical of the $1.9 trillion stimulus, saying this is too much money, the economy can't take it, and this could fuel inflation. What do you make of that argument?
Yeah, it's a crucial question, and we tend to think that that inflation will not turn a corner aggressively anytime soon. But I've seen what Mr. Summers said, and interestingly, the very same Larry Summers, he thought that the plan in 2008 from the Obama administration in the great financial crisis was too small. So it's not about telling him that he doesn't like stimulus. Inflation happens when you have full employment and a saturation of the capacity utilization. We are really far from that. And there is a mystery around inflation. We all have to be very humble ourselves, investment specialists, economists, everyone, because there is a mystery around the fact that it has disappeared, even in Japan with these amounts of MMT. So there is demographics, it hasn't changed. Technology, if anything, it has only accelerated. Globalization is also a factor to keep prices low, and frankly, you've seen the numbers from the exports in China. Globalization hasn't stopped with tariffs at all. So we think that these factors are still in place. Of course, it's inflationary at the end. What will happen is that prices will rise where money will be spent. Currently, it is saved. It's not spent in services. We won't see inflation in services anytime soon. And anyway, the central banks will be tolerant towards inflation. So in 3 years down the road, yes. In 2021, no, I don't think.
Okay, we're going to wrap it up now. I'm going to finish by giving each of our speakers here today, Khatija's not with us, but each of our speakers who are with us today in the studio, just 30 to 60 seconds with one last piece of advice, one final thought that you want to leave investors with. Ladies first. Anita, I'm going to go with you. What would be your final parting shot, your final thought, your piece of advice to leave people with?
I know the concern that everybody today has is, are the new highs that markets are making, is this where the music stops, and do we need to start getting back into cash? No, because the returns, if you want to get them consistently, if you want to see that 7 to 8% equity generate every year, that only happens if you are invested. You really cannot time the market. So follow our asset allocation, follow our mix of emerging market and developed market allocation. We have a higher weight towards emerging markets, added this year because we think that's where the growth is going to come from. Overlay that with the themes that we like, the sectors that we like, technology and healthcare. Everything that we do is simply based on where we see growth, where we see sustainable businesses, where we see consumer trends. And again, I'm saying for the decade, focus on a combination of health and technology, the synergy and the environment. That remains very important as governments and companies spend more and more on ensuring that climate change is not very extreme.
Anita, thanks very much indeed. A final parting thought on fixed income. Satya, your 30 to 60 second parting piece of advice to the people watching today.
The key information that I want to share is that the beta of credit to equities has diminished significantly across sub-asset classes, right? We had example in September and October last year when S&P had a drawdown. The high yield and emerging market debt spreads actually did not move much. So that means that even during a low rates, low return scenario, fixed income should be a part of our portfolio, and they would protect our portfolio during the stress periods. And as I mentioned, in the various strategies that we have run through during the presentation time, if you play the fixed income asset class smartly, you will also be able to get decent returns. Thank you.
And finally, Maurice Gravier, as Chief Investment Officer, I'd love to get your final parting thoughts on this. If we're not going to be spending our time on Reddit and day trading shares of GameStop in 2021, how should we be spending our time and our money?
I think that if I have to really to select a message, it's not going to be the most optimistic, it's the most realistic. With all this magic money, it sounds great, and we've had great performances in a devastated world. Clearly, we have borrowed returns from the future, and it's something that is very important to keep in mind. It means that we'll have to pay back. I'm not saying with crashes and devastation. We'll have to pay back with low expected returns looking forward. And I just would like everyone to keep that in mind, that 3% is the new 7%. And everything starts, I know it's very boring and fundamental, but everything starts with your time horizon. Then the golden rule is diversification. Don't try to catch the hot stocks or do that with money that you would be happy to lose. But frankly, I think there are nicer way to spend money than to lose it by speculating. But again, we have borrowed returns from the futures. It always works. The magic actually is the compounded returns that grow annually. Set your time horizon, be diversified, and it's going to be fine. But again, 3% is the new 7%. Take care of advisors who will tell you, hey, I have something that will make 10% per year. Either it's super high risk or they are lying.
Maurice, thank you very much indeed. A good word to end on. As your moderator and a business journalist, my advice would be stay away from Wall Street Bet. Instead, download the annual investment outlook from the CIO office of Emirates MBD. It is available for free on the website. There's so much advice in there. But for now, thanks to Maurice, Anita, and Satya here in the studio, to Khatija, who joined us live as well. But most importantly, for you, for sharing your time today, for joining us, for taking part in our polls, and for all your insightful questions. Shukran jazilan. Ma salama.